Let me bring in Dhirendra Kumar, the CEO of Value Research, of course, who joins us on the show. Dhirendra, thank you so much for joining us. Of course, like we were talking about, it's possibly time to review our portfolios entirely and find out what we should be holding on to, especially given the way the market is right now. Can you take us through how we should measure whether or not a particular fund has been performing well, especially in the case of equity?
Many investors are, getting disappointed with their performance, irrespective of their funds doing well. So I think first and foremost, investors need to have a comprehension that your equity funds will not do well if the overall market is not doing well. At this point, if you are evaluating your investment, I think you should be looking at it that is your fund doing consistently worse than its benchmark. That's the first yardstick. Then you have to see that, if it is doing so, if it is not doing so, then are there other funds which are always doing much better than the fund which you own? So that is where the relative performance comes in. And then if your fund is doing this very well, then I think the third, which is most important question to ask, is that if the market turns around, will your fund be just as well geared to participate in such a rally? Because the fund which is doing much better now compared to, relative to the benchmark, relative to other funds, it must be doing it by avoiding certain sectors and avoiding certain kind of stocks, and markets turn around. So I think having this framework in your mind that you will not do well if the market struggle, doing okay in a struggling market is not all that bad.
Well, Dhirendra, assuming that our fund is not doing well right now, how much time should we give a fund that's trailing its category average or the benchmark? Assuming we're long-term investors, is it 3 months, 4 months? How long should we wait for the fund to recover?
I would say that, look for a part of the market cycle. You really can't wait for the full market cycle to form an opinion, because by that time you would have missed the opportunity anyway. But I would say that 4 to 6 quarters, and if the fund settles at the bottom quartile and before that it was doing extremely well, I think something is dramatically wrong, and the fund is unable to reconcile with that. But there could be occasion, there has been occasion in the market when a fund which has done very poorly over a period of time has made a remarkable comeback because the fund was right. So I would say that it is entirely a qualitative judgment. It entirely depends, this time frame is a function of how old the fund has been and how often the fund was right in the past.
All right, Dhirendra, since we have you with us, we have a question from one of our viewers. Christopher Stanley has written in. Now, he started investing in the DSP BlackRock India Tiger Fund. This is an infrastructure fund back in 2009. Now, he stopped after making 4 investments for 4 months, and he now has about 24,000 rupees in this fund. He obviously knows that it hasn't done very well. He wants to know if it's time to take his money out, maybe invest in another fund. What do you think he should do right now?
I think, you should have taken the money out after 4 months anyway, because, the reason why you would have stopped this DSP BlackRock Tiger Fund, I would say that it is very similar to an infrastructure fund. And by 2009, I think the story was over. And the very reason why you discontinued your SIP is the reason why you should have pulled your money out. For next 2 years, so you should move your money. Now for 2 years, should you be considering a balanced fund? I don't think so. 2-year fund, because balanced fund is almost like an equity fund. It's just 30% fixed income. And 2-year time is not good enough to take an equity exposure. I would suggest that, consider an FMP or consider a short-term bond fund. Because in 2 years time frame there is a possibility that the market goes nowhere or goes down further, and with this time frame and the kind of goal that you are saving for, this may not be a negotiable one.